In the last chapter, we looked at how a business's financial position is organized and presented by looking at the balance sheet. The balance sheet is only created at the end of a fiscal period. However, throughout the fiscal period, there are various financial activities that are occurring which need to be accounted for and which need to be recorded, such as a company buying more office furniture or paying off a loan. Those are two different financial activities which will change the financial position of a company, and that needs to be recorded. Today what we're going to do in this video is we're going to start looking at the various transactions which occurred during a financial period, and how those transactions are recorded so we could accurately determine what the financial position is of a company at the end of a fiscal period. We're going to begin by looking at transactions. A transaction is an event that causes a change in financial position. For example, you buy your lunch. This will decrease the amount of money that you have on hand, and it will increase your miscellaneous expenses. Or maybe you pay your mortgage. That will decrease your bank balance, and it will also decrease your mortgage payable. Or another example, say your company purchases miscellaneous office supplies. That is going to increase your office supplies account, and it's going to decrease the amount of money you have in your bank. So it's any financial event that will cause a change in your financial position. All transactions are represented by a source document. A source document is the original record of the transaction. The source is given to the accounting department with the information that the department needs related to the transaction. A source document provides proof that the transaction has occurred or that a payment must be made. They are kept on file for future references in order to answer any questions from owners, managers, auditors, or government agencies. An example of a source document would be a receipt or a bill that you must pay. Remember, all accounting entries are made from source documents. The source documents are kept on file for reference purposes and are proof of transactions. The transaction made will also affect two areas on the balance sheet. Now let's practice identifying various transactions. Let's take a look at the first one. A. The business pays $800 to Mercury Finance to reduce the amount owed to them. This is a transaction because it is represented by a source document, but also this is changing the financial position of the company. B. P. Dufour withdraws $500 from the business for her personal use. This is also a transaction because the financial position of the company will be affected by the withdrawal. C. A new employee is needed in the payroll department. P. Dufour interviews Stan Martin for the job. This is not a transaction because there's no financial change that is occurring to the company as of yet. The employee is only being interviewed. D. A $700 consulting service is provided for Rita Bertoli on credit. This is a transaction because this will affect the financial position of the company. Now all these transactions have to be recorded. Since a balance sheet is the last financial statement to be made in the accounting cycle, it might not be the best place to record all these transactions. We're going to have to record them on a different sheet. It's called the equation analysis sheet. The equation analysis sheet is a chart that will help you identify and record all the transactions that occurred during the fiscal period. To begin completing this chart and recording transactions, you must use the balance sheet from the last fiscal period. Here is an example. We're going to take the balances and accounts from this balance sheet and use it to begin recording our transactions. The first thing that you must do when completing this sheet is to set up the opening balances with the balances off of the balance sheet and the accounts off of the balance sheet, as so. We are going to add our assets, liabilities, and owner's equity right off of the balance sheet. Take a look at the headings. Now we're going to add our beginning balances. For example, cash is currently $13,500 on the balance sheet. So, on the equation analysis sheet, it's going to be $13,500. Our balance for the Kava account is $1,300. We're going to add that right to the top of our equation analysis sheet. And we're going to continue this all the way through with our liabilities as well as our owner's equity. Now, we need to ensure that our left side is balanced with our right side by applying the accounting equation. Assets equals liabilities plus owner's equity. Now that we know that we are in balance, we could First, we could begin by recording our first transaction. So our first transaction here says Metropolitan Movers pays $1,200 cash to Mercury Finance. In this transaction, we are taking cash and we're giving it to one of our creditors. This will decrease our cash account and it will also decrease the amount of money that we owe to Mercury Finance. Our transaction will be recorded as such. But take a look at the second line where it says transaction 1. You must write transaction 1 into this line right after the beginning balance because it is your first transaction. And then you'll note under the cash account, we're reducing $1,200 from the $13,000 beginning balance, which will give us a new total of $12,300. We're doing the exact same thing to our Mercury Finance account. We're decreasing $1,200 from the $18,000 that we owed them, and it's going to make our balance $17,000. Now we owe Mercury Finance $17,170. The next transaction reads, Kay Lincoln, who owes Metropolitan Movers $2,500, pays $1,100 in partial payment of debt. This means that Kay Lincoln is giving us $1,100 of the money that he owes us. The transaction will be recorded as so. Transaction 2 will be written, and then our cash is going to be increased by $1,100 because we're receiving that money, and Kay Lincoln's account will be decreased by $1,100 because he's paying us that money. Once the accounts affected are modified, the new balances will be added up. So our cash is going to be modified to $13,400. That's how much money we now have. And the Kay Lincoln account is going to be $1,400, and that's the money that Kay Lincoln now owes us. All the other accounts are going to remain the same because no transactions have yet affected them. Again, we must now ensure that our left side is equivalent to our right side. In this case, it is once again balanced. The next transaction is equipment costing $1,950 is purchased for cash. What this means is that our company bought equipment and we paid it with cash. Now, cash is going to be decreased by $1,950 because it's the money that's going out, and our equipment is going to be increased by $1,950 because we're adding to that account. The transaction will look like this. Once again, we're going to add up our new balances at the very bottom and ensure that we are in balance. So our left side is equivalent to our right side. So now the next transaction reads, a new pickup truck is purchased at a cost of $18,000. We pay $10,000 cash and borrow the balance from Mercury Finance. What this means is we're paying $10,000 out of our pocket and Mercury Finance is paying the remaining $8,000. Now 3 accounts are going to be affected. Our cash is going to be affected as it's going to be decreased by $10,000. Our trucks account is going to be affected because it's being increased by the full amount, which is $18,000, and our Mercury Finance account, our loan payable, is also going to be affected. It will be increased by $8,000. The transaction will look like this. Again, once you do the calculations that are required, the new balance will be written right underneath. So our cash is now $1,400 is what we have. Our trucks account is now $42,000 and our Mercury Finance is $25,000. We now owe Mercury Finance $25,000. And again, we're going to ensure our left side balances our right side, which it currently does. And now we're going to move on to the next transaction. The next transaction says Metro Movers complete a storage service for BCAVA at a price of $1,500. A bill is sent to BCAVA. This means that we carried out a service for BCAVA and they now owe us money. The transaction will look like this. Our accounts receivable will increase under the BCAVA account because we're now expecting $1,500 from them, and our equity at the very end here is also going to increase by $1,500 because we have made a profit off of this service. Once again, we are going to ensure that we balance by adding up the left side and the right side after we have totaled up our new balances, and now we move on to the next transaction. The next transaction reads, Jay Hoffner, the owner, withdraws $500 for personal use. The transaction will look like this. Our cash will decrease by $500 because money is being pulled out of the company, and The equity of Jay Hoffner will also decrease by $500 because the amount that he's actually worth will also be decreasing now due to this withdrawal of cash. Once again, once we total up the new balances, we have to ensure that our left side is in balance with our right side. And right now, it currently is. The last transaction here reads, one of the trucks requires engine work costing $75. Repair is paid in cash when the truck is picked up. This is going to affect our cash account because it's money coming out of our pocket, and since no other accounts can be affected right now, it's going that $75 to balance out our cash will have to go into our owner's equity. Later in the course, you will see why this would be going into owner's equity, but for now, because no other accounts are being affected, we'll just put this value into owner's equity. And it will look like this. Once again, after we've come up with our new balances, we have to ensure that our left side is equivalent to our right side. Again, we're in perfect balance, and we can now move on to the balance sheet. Now that we're done recording all the transactions that had occurred throughout this fiscal period, we have to create another balance sheet which shows that our accounts are ready to move into the next fiscal period. So this is done by taking all the balances at the end of the equation analysis sheet and recording them into the balance sheet. So to begin, we're going to start with our cash as it is our first account, and we're going to record that into our balance sheet. So cash now on the balance sheet is $875. We're going to do the same thing with our BCAVA account. BCAVA, the account ended with $2,800 in it, and we're going to record that into the balance sheet. The K Lincoln account ended with $1,400 in it, and again that will also be recorded into the balance sheet. And we're going to do that with all the other accounts on the equation analysis sheet. The next few slides are a summary of the steps in analyzing a transaction. It'd be wonderful if you were to copy them down and be ready to bring them into class the next day because we're going to be practicing how to do our own equation analysis sheets.